Hello, everybody. This is Jake Stenziano, host of the Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
Mr. Stenziano, I'm doing good. How are you doing, bro?
I'm trying to make it happen. We're having lighting issues on my end. We got 2 more weeks of construction, and then we're back in the office, so bear with us, folks. 2 more weeks. But the good news is you got 2 more weeks to secure your seat, your ticket for the live event in October 6th and 7th in Nashville. Multifamily Mastery 2. Gino, what are folks going to pick up?
I don't know. First of all, for all the YouTubers, I'm going to call Jake the Prophet today because he looks angelic, as our guest said. So on the YouTubers, you see the light shimmering down on him. So he's being prophetic today. So I think I'm going to let him run with the show.
Give me that D3, baby. Give me that D3. I'm soaking it up right now.
5,000 IUs a day, bro. Anyway, at the Multifamily Mastery Live 2, it's just like last year on steroids. Buy right, manage right, and finance right. We got some fantastic speakers there, as always. It is not a run to the back of the room guru show, for sure. We're going to have our entire team there. We're going to be taking down a deal. We got our first syndication in the hopper, so we're going to be teaching about our syndication, walking you through that. I think it's just going to be a great place to network, to meet people. You're going to meet your partner there. You're going to meet your accountability partner there. You're going to raise a lot of money in that room, and you're going to meet all of our vendors. I mean, what else do you want? What say you, Mr. Prophet?
Dude, the prophet says actionable content. All right. This is not about sales. This is about you getting there and learning for 2 days, networking and growing your business, period. And that's it. So without further ado, we have a very special guest today, Ivan Barratt. He is a multifamily owner, syndicator, and specializes in FHA and agency finance projects. Since 2015, Ivan has raised nearly $30 million in equity. Currently, his companies manage well over $150 million in assets, comprising nearly 3,000 units. So without further ado, Ivan, welcome to the show.
Hey, guys. It's so good to be here, hang out with you guys for a little while. I'm real excited to chat real estate with both of you.
How you doing, Ivan?
I'm doing fantastic. And just hearing you guys go back and forth, I feel like I got to get on the ground and do some push-ups and, get myself a little winded here because I'm all jacked up.
Dude, if you can't get energy on this show, you're not going to find it anywhere, my friend.
Nowhere. I'm going to put the coffee down. I'm going to drink a little water. I'm ready to roll with you guys.
Well, let's get into it then. You just told me a minute ago, you went from a duplex to 3,000 units. Something happened in between there. You want to at least tell me how that got started?
Well, it all depends on where you guys want to go. I mean, between a duplex and where we're at today, I think I hit every branch, tripped over every rock, fell over every root in the forest, just tried to not fall over or hit the same one twice. But very lucky. My father is an attorney, and he owned a bunch of rental properties growing up. I had an uncle that owned a little apartment complex that he ran sort of mom and pop style. And when I graduated high school, my dad gave me Rich Dad, Poor Dad and told me not to be a lawyer because that's what I thought I wanted to be. He said, don't be like me, be better, be an entrepreneur, and hire great attorneys. And, I'm thinking, hey, this real estate thing sounds pretty cool. You just have a bunch of rent checks come in and I don't have to work. What could be better than that? So it turns out it's a real job, learned some lessons the hard way. But in 2010, started my own business, Barratt Asset Management. We call it BAM now. We're the BAM fam.
Oh,
and today we manage several thousand units, and we focus on larger apartment communities. We're vertically integrated. We've got a team all in-house in every aspect of real estate, and things are getting fun. Things are getting fun.
Where did you start buying your assets?
So I'm in Indianapolis, Indiana. When I graduated college, where I actually went through the business school, back in the late 90s, early 2000s, they'd let anybody into business school. I still don't know how I got in there compared to today, but walked out with, some knowledge on how to work an Excel sheet, some basic fundamentals of real estate. My dad says, hey, I'll max you on your down payment if you buy a duplex and live in one side and rent out the other. If you go buy a single family house, you're on your own. I'm like, okay, I'll give that a try. So he sort of pushed me into house hacking a little bit, and at the same time started working for a real estate developer. At the time, that's what I thought I wanted to be. I wanted to do big speculative deals, build it, sell it. I'm rich, bitch, flipping real estate, right?
Mm-hmm. So what drew you to
Can I say bitch on your show?
Yeah,
whatever you want, man. Just bring the pain. Be real, my friend. Bring it.
And 2007, 2008 comes along, and it ends up being the biggest gift of my life, because that young, stupid cowboy that thought real estate was easy got slapped in the face and had to hit the reset button on everything. And again, that's when I started the property management company first, and worked on scaling that, managing effectively for other people, so I could start buying my own properties as well.
What was the biggest lesson from that slap down?
Well, there's a lot to unpack there. The biggest lesson would probably be, what can go wrong in real estate if you misjudge or mistime the market. And when you're doing development, when you're flipping deals or doing ground up construction, if you screw up one thing, your equity can go poof.
Mm-hmm.
And so when everything's going well, it seems great, it seems sexy, there's these big returns, but you're not playing the cash flow game at all. You're playing the capital gains game.
Mm-hmm.
And I had forgotten that lesson in Rich Dad Poor Dad, and got firsthand exposure to what can happen in real estate if you don't have that cash flow, you don't have that income property, and you're just betting on the come.
Ivan, you didn't forget it. There just wasn't there back in 07, 08. The risk premium, cap rates were 5. The T-bonds were at 3 or 4%, whatever they were. There was no cash flow back then, correct? I mean, so it was all speculative. It was all like, hey, you know what? I bought it for this. I'm going to flip it for this. And it was a scary time to be, correct?
Yeah, you are absolutely correct. I remember getting on LoopNet and underwriting deals just to say, okay, what would make this a deal? And the delta between what I could pay for a property, a cash flow income apartment unit, versus what other people were paying for it was enormous.
Mm-hmm.
And so you're absolutely right. People that stuck to the fundamentals were unable to purchase a lot of property in those days.
I think Jake loves the book Ray Dalio. I always talk about it. He talked about two things: blind spots and egos. Right? I think back then, if you had been a little bit older, a little bit wiser, you'd have seen that, hey, listen, I got to pull the brakes, the e-brake. And a lot of people missed it, right? Because like you said, there's no cash flow. The prices were crazy. Jake and I like to focus on buy right, manage right, finance right. What part of that do you think is the most important in multifamily?
Yeah, well, you just reminded me, my old mentor would still say today, in real estate, what you don't know that you don't know will effing kill you.
Mm-hmm. Mm-hmm.
And that's a big lesson there.
Mm-hmm.
And your question was buy right. What do I do to buy right, manage right today?
Yeah. What is your biggest thing? Because Jake, we love to teach. You have to buy the asset properly. You have to manage it properly. That's right. It's the wheelbarrow. Managing is ongoing, and finance right. Which one of those three, or all three, do you think is most important in real estate?
It's a trifecta, right?
Mm-hmm.
If you fail to execute management, you can take a great deal and screw it up in a week.
Mm-hmm.
And if you've got a really great management team, you can take what would have been a mediocre deal and eke out a very solid return.
Mm-hmm.
For us right now on the buy right aspect, we're looking at 200 opportunities to find one. And so when I talk to newer real estate entrepreneurs, one of the first things I say is, listen, if you haven't underwritten a couple hundred deals yet, it's not certain that you don't have a good deal on the line, but it's a big red flag if you think you got a deal and you haven't done that much underwriting.
Mm-hmm. So what do you look for in a deal as far as buy right? What are the parameters you're looking for, the market and the actual returns on the deal?
Yeah, so today we're a little bit different than we were a couple years ago. We are less cap rate chasers.
Mm-hmm.
So now we don't really chase the cap rate going in. We're more concerned with what's the cap rate going to be in 12 months, 24 months, 36 months. And we are staying away from heavy value add deals. All those deals are in the hood right now. Mm-hmm. The good value add deals are being bid up to a price that doesn't justify the risk.
Yep.
And so we're finding value in higher class assets, B plus, A minus assets in A locations, A submarkets, and there's equity out there that would take a slightly reduced return if you can take most of the risk off the table. And then and to do that, we marry those deals right out of the gate to long-term financing. We stay away from the banks in almost every one of our deals.
So on your deals, are you syndicating your deals? Are you raising private money for the deals?
Yeah, it's all syndication. So we keep our LPs in the loop every step of the way. We've got about 80 LPs now. Over half of them have done 2 or more deals with me. And we're typically oversubscribed. Finding equity for me is not the problem right now as much as finding the right opportunities, because the quickest way to lose my investors is to do a mediocre deal just to get the fees out of it.
Mm-hmm.
And we built this company out of the ashes of the Great Recession to be patient, to be disciplined. And that's why we started the management company first. I've got almost 70 employees now, and I don't have to buy a deal or sell a deal or refinance a deal to make payroll. And I like being in that position. And I like being able to put food on the table without having to get too aggressive on the acquisition side, because I think that's where a lot of this is going, and we're going to see a correction some point down the road. Winter always comes, no matter what.
Hey, you like that?
He's getting Jon Snow on you right now. He's bringing the
hey, Jon Snow stole that from a great book called The Fourth Turning, and it talks about how nobody knows how cold it's going to get, how long it's going to be, how fierce it's going to be, or if it's going to be mild, but winter always comes.
And to your point, these guys that are buying these deals right now that are the 80s vintage, and they're really jacking up the price on them because that's what they're comfortable with, and they keep compressing the returns. They're even reaching into submarkets now and paying what they'd pay in a primary market. And that's what scares me, because we're looking at a deal right now. We're right there. It's probably $400,000 too much. Real damn close, but I know that little extra reach up, once you start going there, it's gonna put it over the top. And if it does happen to turn and we get caught, that's gonna wipe all the value off the table on this thing. So you gotta be patient, you gotta be persistent on this stuff. Yeah,
the way we play that, because we're in tertiary markets, we're in secondary markets, Indianapolis. We love Big Ten cities. I bought several workforce housing deals in Big Ten college cities where you got a university, you got a hospital, diversified employment, lots of service jobs. And you can typically get more yield there. But yeah, you're absolutely right. Returns are being compressed. The key is, though, equity is still demanding of an income producing asset. So for us, in order to minimize that risk, like you talked about, we will go straight out of the gate with agency or even HUD financing, which a lot of people don't know this. HUD finances A, B, C, and D assets. So you can get your shiny new assets financed through HUD, and that pushes out our maturity. So we like a really long maturity. You might not be able to cash it out as quick or refinance as quickly, but my investors, their first rule is don't lose money. Their second rule is remember rule number 1. And the third rule is how do we get yield? And so we'll go out and buy a really solid B+ asset, A- asset in some of these secondary and tertiary markets, only if we can fix the downside.
You going out 40 years on these things? 35, 40? How long are you going out?
HUD's 35, and then Fannie, we're going out between 12 and 15. Yeah. The only thing that would keep me up at night on these short-term deals is if we see a 2007-8 again, capital markets freeze up. If you can't roll over that debt, guys, as you two know, you're screwed.
We were looking at a deal. It was a 40-40 the other day. And I was just like, because the guy developed it. So when you're actually building this stuff, you can actually go out even further than that versus your typical 35, 35. I'm like,
D4 construction is a 40-year amortization.
Man, and I'm like, because sometimes you're looking at yourself, how the hell does this shit work? And then you add that extra 5 years onto the AM, and it's like, okay, starts to make a little more sense.
That's so crazy how the government actually can control it and can actually control the market and actually create a product out of nothing. That would never work with a 30-year AM. And then you look at a 35-year with a 2.9% interest rate. It's like, dude, you're giving money away to these guys for free. They're subsidizing the builders. But I can understand why, because it's an asset. You're going to get cost segregation out of it. You're going to get investors out of it. You're going to get jobs out of it. You're going to get a beautiful asset out of it. But when you guys look at it, it's like, I can't believe it.
Well, and let's remember, guys, we have a shortage of affordable market rate workforce housing in this country. Mm-hmm. And if HUD's not financing it, there's going to be a real lack of property rental property that people can live in. You know, they're not building any more of it. Everything getting built right now, for the most part, shiny new Class A assets.
Yep.
So we see this demand in the market, and we still see rent growth, at least in the Midwest, for that segment.
Mm-hmm. Walk us through your first syndication. I mean, what did it look like? What were the splits? What was the raise? What was the deal? What was the hair?
My first syndication, oh man, what a mess.
Good. That's what we want to hear. We like messes here.
Yeah, my first true syndication was 60 units. Probably paid a little too much for it. Didn't do enough due diligence. And I just had a few friends involved, but I had to raise about $600,000. We got the 60 unit deal. We still got it. We've refinanced it on a Freddie Mac small balance loan. It's a great little cash flow deal for us now. The cautionary tale there is, if you're a visionary entrepreneur like I am, you need an integrator on your team. You need a grinder. You need a guy that's got his nose on the grindstone.
Dude, he's going EOS on us, Gino. He's going EOS right now on us, baby.
Oh yeah, big time, man. You need that integrator. And I was just lucky. My partner and I've been together for 3 years, and he is that guy. He's the COO of my company. He's the peanut butter to my jelly sandwich. And I tell you what, I would have screwed it up, royally and irrevocably if I didn't have the right partner on my team, who can fill in that other half, from my weakness standpoint. He's 10 times smarter than I am. Maybe almost as good looking, but definitely 10 times smarter.
So let me ask you, what was the other pain points? I mean, was it hard to raise the money? Was it hard to find the deal? What did you like about the deal?
Yeah, in those days, I liked it because it was a 60-unit deal that I could get for a good price and good cash flow. This would have been late 13 when we got that under contract. Workforce housing, great school district. Demand in the market, lots of nice homes in the area. That's what we liked about it. Raising the money, I had already done a couple deals where I just brought in one partner. So oftentimes I'll recommend, you can do like a syndication light if you're doing a small deal and you've got some existing relationships. But no, the raising the money for me was not the hard part even then, because we had a good business plan, we had good projections, we had dotted most of the I's and crossed most of the T's, at least we thought we had. And those early deals, you're going to hit bumps in the road, and your investors want to see how you respond to that. And I tell you what, every one of those investors has done more deals with me, because of how I reacted to the bumps in the road, how we stayed transparent, right? And we've just continued to up our game.
Mm-hmm.
Yeah.
So give me a couple tips for raising private money, since it seems like you have that skill set. Any big tips for the listeners?
My biggest tip is, as an entrepreneur, a capital raiser, my biggest tip would be spend a lot of time listening to great content on developing business and developing yourself, because raising capital has a lot to do with selling yourself. And so the good news is, sales is not something that you're either good at or you're bad at or you're born with. It can be learned, and you have to be able to convey an idea and get buy-in from a potential investor. And that's more about selling yourself and learning how to sell, just as much as it is understanding the real estate.
I love that.
So for me, I raised, of that 30 million, I would say somewhere between 25 and 27 million is all through networking. It's all through referrals. It's through getting to know people, establishing relationships, finding common ground, staying in front of people. Crowdfunding can be a great idea, getting on bigger pockets, advertising your deals, that kind of thing. Mm-hmm. But I think a lot of people fail to realize just how much money is in their own network that they didn't even know was there. Right? Like, there's no way I'm going to go to my doctor's office and get a checkup, or go to my dentist's office and get a checkup, and not find some way to get the conversation on real estate and what I do.
Why is everyone getting these physicals and asking their doctor for money here? They're like, hey,
you don't ask for the money. You don't ask for the money.
Call for me,
you
buddy.
just make sure they know what you do. Everybody wants to be in real estate.
I got an opportunity for you, Doc. Now it's a funny recurring thing we've heard a bunch of times. Guys will be like, yeah, he was down there making sure that everything was good, and then I looked him in the eye, and I said, "You ever thought about real estate, Doc?"
I haven't tried that sales approach yet. I haven't tried that one.
Says the prophet. If the prophet says it, you got to try it, right?
You look him in the eye and you say,
"That's right."
You ever thought about real estate, friend?
Hey, listen, don't knock the prophet until you've tried it.
Dude, you got to go there, man. And it's when you can get comfortable with someone at that level and you know each other that intimately, there's no way he's not giving you money, right? You're halfway there.
The best thing you can do is get one doctor and treat him very well, and he will tell all his friends.
Yep.
And most people are like that. If you treat them well and you give them a good deal, they're going to tell everybody.
Yep.
And that you can really build some great momentum just by getting to know people, getting them in your deal, treating them well. They're going to tell a friend or two.
Mm-hmm. I love that. Ivan, what are your typical splits on deals? LP, GP structure, fees, and all that?
Man, you guys like to get deep here. I love it.
He's looking down the pants, man. He's like the agency dad. He wants to see the full picture, you know? I
feel something down here. I think you guys are holding on. No. It depends on the asset and the vintage, but typically we're paying a pref between 7 and 8%. And we're typically splitting deals 70-30. There'll be a scenario where we start doing IRR hurdles because we've had a couple deals where we hit it out of the park and the split should have gotten a little bit better for us. So that'll change as we get a track record and we get a little better, a little more complex. Fee structure, we typically roll in our acquisition fee back into the deal as a deferred profits interest, which allows us to get a return on that cash from day one. So it's like me investing hard cash, as well as real cash we put in. You got to have real money in the game or you're not going to attract smart people. And then from there, we're typically charging asset property management fees because we're vertically integrated. And that's really about it. We try to keep it as simple as possible.
It's funny, Ivan. You said your partner was smarter than you. I've learned syndication on the show. I've learned from multiple guys how they structure their deals, and it's sort of very similar. A lot of guys, but a lot of guys aren't vertically integrated like you. So you can control the asset and you can drive the performance of the property. I think that's a huge advantage that you have over a lot of other syndicators.
I'm not going to get a call from my property management company and telling me that they've transferred the property manager that I'm in love with to a different property because they need her somewhere else. Mm-hmm. We sign those checks. And our property management company is a loss leader. It doesn't make a lot of money. What it does do is it builds a phenomenal machine. And then we take whatever little profit we have and we reinvest that in our people and our tools. And just between you two and me, just between us, mm-hmm. You pay people more money, you tend to attract better people who tend to stick around longer and do a better job.
Totally.
And that's the key to property management. You got to treat your people like gold. You got to find ways to make it more fun and interesting because it's still, I'm just going to say it, it's still fucking property management. It's hard.
Work, man. It's hard work.
It's hard, man. And the people that do it, the people that do it have to work really hard to get it done right. And so we just try to be mindful of that and figure out ways to keep our culture fun. And because it's not always going to be that way.
Mm-hmm. I love that. How have you been able to build your systems or your teams up from, couple duplexes to, managing thousands of units now?
Yeah, it's all about the team. I took way too long trying to do it all myself. In the beginning, when I started my company, I had a bookkeeper and I was everything else. Leasing agent, maintenance coordinator, property manager.
Gino, you feel like you're looking in the mirror here or what? He's about to get into I'm a mentality right now.
That's right.
Uh-oh. Yeah, I waited way too long to start hiring people, and I've made every mistake in the book on hiring people. But eventually you tinker with it. You don't give up. You stay persistent. You start finding better people. And now it's the machine, the culture here has its own momentum, and it's really fun to watch as the founder.
Well, that takes time though. I mean, because when you're first starting out, it's just like buying deals, right? You don't know, or like I like to say, having kids, you have your first kid, you don't know what you're doing. By the time
there's no way you're going to get it right. You just got to go. You just got to do it and figure it out.
Yeah. And you have to have that leap of faith. By the time you're hiring the guys out, you're like, okay, I'm going to figure out where I have to generate the revenue to pay this guy. And then it'll just appear. But I think it's a leap of faith. And I think you need to have a partner pushing you to do that. Because if not, you won't get off your ass and do it, because that's the bottom line. You're just like, I'm comfortable having the bookkeeper. I'm comfortable being the maintenance guy. I'm comfortable being the leasing agent. So from there, when you started building that out, I mean, what platforms do you like to use? Do you guys use AppFolio? I mean, what kind of software and stuff do you guys use?
Yeah, when I was managing the small stuff, I started out on Propertyware, and then we made the switch to AppFolio a few years ago. My team loves it more. Mm-hmm. And then somewhere down the road, as we get more institutional, we'll go up with one of the big boy platforms. But AppFolio does a lot, and it does it very well.
Good.
Yeah. For us, we have to have accounting in-house, some accounting, because of the compliance with HUD. They don't just give you the money and say good luck for 35 years. There's a lot of brain damage. And I read this great book a while back. It was the founder of FedEx, Mark Garofalo. I probably butchered his name, but he's got a book called Copy This. And the basic premise of the book was anybody can do this job better than me. And using that, and then a line from Tim Ferriss that he'll repeat a lot, is you have to learn to let little bad things happen. You have to learn to hire people, let them screw up a little bit, let them know that you're not going to be upset about it, right? And let them learn and grow. Otherwise, you're going to end up just being a micromanager, and the whole thing tends to fall apart.
Dude, it's the issues board, right? It's the issues board from Dalio. Basically, you cannot try to suppress this stuff, because if you don't, you got to get it out, put it on the issues board, and try not to let it happen again, and learn from each one that takes place. Because if you try to come down on people the first time they make a mistake, they're going to keep trying to sweep it under the rug, and then that's when the shit's going to really exacerbate and blow up in your face.
Yeah, you've got to build that environment where they know that they can screw up and come forward and say, hey, I screwed up, right? But this is how we're going to do it better next time. Absolutely. Yeah. When's Ray Dalio's other book coming out? I'm waiting for that one.
I saw something that he's got some economics book coming out, but I don't know when, I think that's something different than what you're asking about.
That's what I'm asking about. He's going to come out with economics, but also his investment decision, like how he makes investment decisions, how he views investments, which I think should be pretty exciting as well.
Yeah. I saw some ad for it today on LinkedIn or whatever, but so I think
good.
I think the one's coming. Yeah.
We must be getting close.
Dude,
I'm a Ray Dalio fan.
Love him. Yeah. Love him.
Well, one last question before we go to the short ones. What is your best real estate investing advice or tip for the listeners?
This game is really about just being persistent and don't quit. And I would say it's a lot like working out. It's the little things that you do every day to move the chains or move the needle, right? You're not going to go to a one-day thing and all of a sudden you've got everything you need. Go to a seminar, get education, right? Get that foundation, and then just follow the plan, right? And if the plan needs to change, you can change it later. But stop looking at all these shiny objects. If you want to do multifamily, get some great education, and then just start doing the little things every day that take you that direction. And don't worry about looking up at the top of the mountain. Just focus on putting one foot in front of the other.
On the personal side of things, what would you say your best habit for success is? Something you do on a daily or weekly basis that helps you get in the right state of mind and continue
easy.
on?
I fill my brain with content. It's less real estate focused now because I'm up and running on the real estate, and it's more self-improvement, self-enhancement, and even still, I had my first sales job at age 15. I had to get on a bus because I didn't have a car yet to go sell shoes at the mall. And I still listen to sales training, business development books, and that keeps me motivated. It keeps me sharp, and it doesn't let me relax on what I know I need to be doing. And so in the car, washing the dishes, getting up in the morning, whatever it is, even if it's only 15 minutes in a day, I'm getting that content in every day.
I'm really with you on that because we speak so much on the podcast to different guys. So we're getting that content, all the time. I'm more focused on personal development, personal growth. I'd rather, read Ray Dalio 3 times than pick up another real estate book at this point.
Right.
That feed here. So with that being said, what's something that you've gravitated towards in the last year or so that you're like, man, I gotta let people know about this one. This book has really impacted me and I want to share it.
Man, a book just in the last 2 years?
Yeah, something. I mean, because everyone throws out, I read Rich Dad and it was the greatest thing ever. And we kind of touched on that. And that's the cop out, right? So what's something that it could be on the personal growth side of things? What's something that you want to recommend at this point?
So the book that I've read the most in the last 2 years, I've listened to it 5 times now.
That book. Yeah, that book right there. What's that book?
If You're Not First, You're Last by Grant Cardone.
If you're not, no, that's like Ricky Bobby, man.
Dude, it's the story of Ricky Bobby. I don't know who had that
Ricky
first,
Bobby,
dude.
man. I love Ricky Bobby.
I don't know what should I do with my hands here, guys.
Dude, you're naked, Ricky Bobby. Come on, put your clothes
I don't know
on.
if anybody's gonna. I don't even get the hands joke from Talladega Nights, but I'm doing it right now for your listeners. It's a phenomenal book on just lots of tactical information on just how to hustle the right way and how to get shit done. It's awesome, man. I think it's his best book, personally.
Have to check that one out. And I think that's, going to that point, it's like guys like Grant and guys like Gary V, on those days where you may have got hit in the gut a few times, you put that on to reset, because you are going to get those gut punches. You're going to get that stupid, personal injury case where the slip and fall bullshit, right? Or the ass grabbing.
This year, man. It comes with the territory. That's what insurance is for.
So you got exactly. You got to be able to take a few gut shots and then reset and get your mind right to keep pushing forward. So.
You have to, man. I got awarded $60 million in assets this quarter, and we might have one more deal. So I gotta check my own self from the gut, because it's fourth quarter sprint time.
Yeah, no, it's real, man. So what about a value add strategy? I love asking people this. A lot of people are like, oh, well, we love rubs. We love doing like dog parks at the bottom of the garden units. What's one strategy that's your bread and butter? It's your I right dive, hut, man. What are you going to? You're on the 1 yard line. What are you punching in, man?
We really finding deals where we don't have to do shit. We just raise the rents.
Yeah. No, that's the easy one.
We work really hard for that. That's our favorite.
Yeah.
That's a 1 in a 200 unit.
We're gonna classify
1 in a 200 opportunity deal. No, what's our
plays?
Yeah. Yeah. So it's not rocket science, guys. We're going in. We're upgrading the things that are easy to upgrade without a lot of downtime and without a lot of hard work. So countertops, lighting, door hardware, flooring, those kinds of things that are easy to turn and easy to get that unit back up. Amenity-wise, we're typically looking to upgrade an amenity or two, whether it's new gym equipment, bark parks. Now, nationally, the highest rated amenities are pet amenities. So pet amenities are actually surpassing human amenities in apartments.
Says it all, my friend.
Yeah.
Woof, woof. And you got to get that poopy scooper, right? The green poopy scoop going,
You can't go wrong with the green poopy scoop, whatever the heck that is.
Dude, the green poopy scoop, the bag comes out, and your maintenance guys love it. So
that's below my pay grade now.
Wow. So what project are you excited about right now? Where can folks get a hold of you?
We've got 90 million in assets in our pipeline to close this year. So we're super excited. They're cash flowing right out of the gate. They're going to have some great debt on them. And thanks to the man in the White House, there's a lot of bad things we could say. But the accelerated depreciation and the first year losses are off the charts, even with the positive cash flows, I'm sure you guys know. I am really easy to find. If you can spell my last name correctly, Barratt, Ivan Barratt. IvanBarratt.com, BarrattAssetManagement.com. My assistant who runs my calendar and who's happy to put anyone on a phone call with me is 317-762-2625. You can't text her. Got to call her. 317-762-2625. And I'm happy to talk more about that. And I love talking to young entrepreneurs and delivering a little bit of value in hopes that they don't make the same mistakes I did.
Amen, brother. Keep the party going. If you keep buying, the depreciation keeps rolling. Just don't quit, right?
That's right, man. Just keep it rolling.
G-Dad, what else you got?
I'll let the prophet roll this one up. I mean, this is a great call. I mean, I like, we got down in his pants a little bit, he said, and we got to get a little up.
Man,
it's so good. It's so good, I'm not going to lie.
The J and G. That's what we like to do. I mean, we like to bring content. It's actionable.
Yep.
I'm hoping that Ivan can make it to our live event in October. Nashville, I think, could be a great addition. I think I love his strategy. I think from starting from a duplex, I like his dad saying, don't become a lawyer. Actually go into real estate. The sales training is wonderful. Sales is a skill that we all need to learn. We're all selling ourselves every single day. So I think that's very vital. And the fact that he's built a behemoth and he's got a vertically integrated company speaks a lot. It's not about how much money you make in the property management, but it's about how you can actually scale up these assets and actually control your business. And the more you control in your business, the more money you're going to make.
Yeah. And a lot of guys, out there syndicating and they're not doing the vertical integration route. And we did it a little bit differently, as all the listeners know, where we bought our own assets. We're vertically integrated. Now we're kind of getting into the syndication realm of things.
Nice.
It feels good knowing that you're in total control. And I think that's the one thing at the end of the day, having the property management, having the brokerage going, having the education, having the marketing arm of the company. When you're in full control, you're not reliant on anyone else to do anything for you. And therefore the investors are going to see that and know that when a change needs to be made and you need to pull that manager out of there, you're putting the new person in. And if you need to shift them around for whatever reason and take one from here to, play chess with it, you're the one doing that for the better of the organization. And that investor is going to see the returns, not another guy that's in, a different market or something who's invested in another deal. So I thought that was a great point that you brought up. And I do really think that, when you start to partner with folks on deals from a capital standpoint, you want to get with the guys that are in total control and they're going to make moves.
I really appreciate you bringing that up. And we've got a deal right now where it's one of our earlier bigger deals, 237 units, and we misjudged the rehab. There's a lot more deferred maintenance even after doing all the due diligence than we thought there'd be. And because I've got those guys on my payroll, I've cut our margin out of the renovation project. And so now we're literally just doing it at cost, where normally I've got some margin in there for project management because it does take project management. Wouldn't be able to do that, right, if we weren't vertically integrated. So it's harder, but I have to stress how much it's worth it if you're going to go big and you want to be around a while.
Yeah. Guys, classic example. We're going through major rehabs right now. We got decks that are being constructed. We're not paying fees on top of that. Our guys are doing it. And to his point, that's the kind of stuff that saves money, because at the end of the day, this game is about income versus expenses when you really get down to it. And if you can control the process and reduce that expense side of the equation, you're going to be so much further ahead of the next guy who subs everything out, who just got into the game to be a syndicator. So like what you're doing, man. Keep
Amen. Amen, prophet.
Thanks.
Thanks, guys. Appreciate it, Adam.
Take care, guys. Thank you.
This is great. Thank you, guys. Really appreciate being here.